See, generally, what is meant by correction means theoretically 0 to 10% fall in an index is a normal movement in theoretical meaning in a market. If markets fall more than 10%, that is Nifty or Sensex falls more than 10% means, then they used to call it as an correction. So Nifty has now from the top it has fell more than 10%. Even mid and small cap also are down by more than 10%. So we call it as a correction. So any fall between more than 20% is called as an a bear market. Suppose if Nifty falls another 10% from here means, then we are theoretically called a bear market. Now we are in correction since overall most of the indices are down more than 10%. It is called in correction. And FIs are sellers, though their selling has come down when compared to October month. So who is selling means, my personal feeling is that it's not only foreign institutions are selling, many ultra high net worth domestic individuals and many high powered stock brokers, they are selling in the market. So that is why we are seeing broad based sell off in the market. Foreign institutions generally don't own this mid and small cap stocks, only select mid cap stocks only they own heavily. And now if you see, the market fall has been broad based. That means that many high powered individuals are selling in the market. That is why markets are falling. Though FIs are selling, it is not up to what they sold in October. And broader markets are weak because of the reason I told, that many high net worth individuals were selling. That is why markets were weak, and most of the selling is now coming from domestic investors, not from foreign institutions. Foreign institutions, they hold most of their stocks only in large cap. And US market continue to outperform, even though yesterday they fell. When compared to most of the markets, they are still outperforming, and their economy also doing relatively well when compared to other economies. And derivative volume has fell. 3 months back, our regulator SEBI took lot of actions to curb the euphoria in derivatives market, and that has started yielding results. Now derivative volume started falling now. And index, if you see, Nifty and Sensex are down around 5%, whereas mid and small caps are down by 7%, it is down. And this is the current correction status. And if you see that Nifty and Nifty next, they are down by 17%. And Nifty is down by more than 10%, that is 10.83% Nifty is down. And mid cap during previous time when market was falling 2 months back, mid and small caps were down by around 7%, like that it was down. But during the current fall, if you see, in mid and small caps fell more than the Nifty, and now they are almost at par with the Nifty fall. And Nifty is down more than 10, and mid and small cap also down by more than 10%. So the worst fall in the index is the Nifty next to 50, that is 17% it is down. So overall market is down around 10%, and individual portfolio, it depends. And some of the portfolios were down by 7%, and some of them are down by 12-13%. But it's not an alarming fall, it's a normal movement in the market. But why the market is falling so sharply now? Whenever market goes up or comes down, we can see lot of reasons to tell.
10%
individual shares generally moves up. I will show in the next slide, sir. But I checked it. We also run PMS on behalf of clients, and checked it morning. I checked for one of the clients. It is down by 8%. So it's not an alarming fall. We own a mix of large, mid and small cap stocks. So it is down by 8%. So 8% fall from the peak, it is down by 8%. 8% fall is a normal fall. So index is down around 10%, it has come down. Many stocks, it has fell by, many stocks are down by even 40-50% also. But when compared to last year, we have to see it. These stocks were up by 7 times, 8 times, like that. For example, many PSU stocks are down by 40%, 50%. But when you compare to 2 years back price, still it is up by 2x, 3x, 4x, like that. So the stocks which has run up a lot, they would have fell the most.
You take HMN, Reliance, or this.
See, we can take any side, sir. Upside also we can take. HL Tech yesterday hit all time high. So just outlier we can't tell and say. And this is and the median stock, this is when compared 2 days back, this data was taken on 8th, and median stocks, though index were down by 10%, the median stocks were down by 20% in large cap, in mid cap 23%, and in micro caps it is down by 36. So what is mean by median means it is the middle of the number of digits. For example, there are 3 digits, 1, 5, 10 means median is 5. Median is 5 because it is the middle digit. So when you rank the top gainers to top losers, means the middle stock that will come, that will would have fell by 20%, and mid caps by 23%. In large cap it is 20, micro caps it is 36. So most of the stocks were down more than the indices. In coming days we are expecting big movement, hectic activity is expected. Hectic activity means it does not mean it will go only on upside. On downside also we can expect good movement. The main reason is that Q3 result seasons are started. Already TCS announced that result. So Q3 result season has started, and based on the result, stock price will see movement. And the next thing is pre-budget expectation moves. Still I remember in during 90s, 2000s and all, whenever budget is coming means then stock market used to move very sharply upwards 1 month before that, an expectation of budget. But nowadays we are not seeing much movement in this. At that time mainly the railway stocks, no, they used to go up very sharply because at that time railway budget was there. Railway stocks used to go up very sharply 1 month before the budget, but it will on the budget day it will sharply fall. But now there is no railway budget and we are not seeing any movement in railway stocks before the budget. TCS results is average results we can say. Is not below expectation. Neither a huge positive is there, huge negative is there. But stock went up mainly because the stock has corrected 2 weeks before the results. Slightly positive, neutral result we can say. And pre-budget expectation moves, we can expect it. Now everyone is saying that there is a fear that the capital gain tax will again be hiked from 12.5 to 15 long term, and short term may be moved to the slab rate. So that is the fear in the market, but I don't think it will come because only just last July only in the budget they have hiked the short term and long term capital gain. But that fear is there in the market. Suppose in the budget if there is no hike in capital gains and there is some relaxation on the income tax miss, then market will see it as a positive and it will go up. And FIs are heavily short in the market, their short position is extremely high. Suppose if some positive news comes on the budget means, then we can expect a sharp up move in the market. The other thing is that on January 20th US President Trump is taking power, and definitely in the first 1 week he will announce some tariff measures or some talks he will make that will make the market either to go up or down, and that's also there. So 3 important events are lined up now, and because of this markets will see good activity. So one big plus thing about this time is that last 2-3 results season what happened was that stocks were up very sharply. Even results were good, we could not able to buy it because the stock price has run up a lot. But this time when stock prices are down now, so when results are good means then we are getting an opportunity to buy the stock. So that is the advantage we are getting this time. This was for last many quarters we haven't got that opportunity. Now stocks are relatively available at 10%, 20% lower than the high, and when results are coming good means generally when during weak result season, even when results are good, stock prices will not go up much. So we could able to get an opportunity to buy it. That opportunity is there now, and budget will be crucially vast for India because for markets to get back momentum. Few months back, almost now Nifty is down. In the last 6-7 months, there is no return in the Nifty, and for markets to get back the momentum, some big announcements we have to expect. In the announcements should come in the budget. Big announcements and tax tweaks should come in the budget, and consumption stocks are very weak. Suppose if income tax slab rates are hiked by 2 or 3 lakhs means, or a big up move comes means, then we may see it, market will take it positive. and capital gain tax should not be touched. It should not be hiked. If it is hiked again, means then it will be seen as a huge negative. So some big announcements should come in the budget, and also the government expenditure is lower than what was told in the last budget. And about that also some announcements should come in coming budget. And the second thing is that Trump government, we are expecting some announcements, and it should not be major negative news for India. Suppose he put some huge tariff for China, but relatively very small tariff on India, means then India, it would be seen as a positive, and big negative should not come from Trump government. These two will be closely watched. Another 20 more days are there for budget and this events to happen, and that will take the market direction. What I personally feel is that market is falling mainly because they want to send a signal to the government that market is weak, so please don't hike the capital gain tax now. And if market goes up very sharply, means then government will feel that market is so positive, then we can again hike the capital gain tax. Like that finance minister may take it. So to warn the government and to say that the market is weak, and in order to avoid them to touching the capital gain tax, market, some big high net worth operators are selling the stocks and keeping the market lower. Last year we have ended, and some slides we can see on that. For the 9th consecutive year, Nifty has closed positive. From 2016, not in even a single year, Nifty has closed in negative. Last year we have got 8.8% return. And previously, though 2016 and 18 the returns were lower, just 3%, we haven't seen the red on the Nifty index. The last one and a calendar year, the negative was 4.1% in 2015. So for 9 consecutive years, market has given positive returns. Generally, equity is seen as a very volatile asset class, but if you see that for 9 consecutive years, the returns were positive. And this is from 2001 to 2024. So in this last 24 years, only 4 years we have got negative return. In 2001, because of because of dot-com bubble. In 2008, because of global financial crisis. In 2011, this global financial crisis had an impact for almost 4 years. So 2011 also we can classify in that. Only in 2015 we got a marginal negative return of 5%. So last 24 years, only 4 years market has given negative return. Even though stock market is a highly volatile asset class, only 4 years we have got negative return. In all other years, only positive return we have seen in the Sensex. So basically in the last 10 years, the volatility has come down. Even though many tell that the market is very volatile, when compared to previous 10 years, the volatility has come down in the last 10 years. And this is the mid cap and small cap index. Here also the same thing. For 5 years, it has given negative return. All other years, we had positive returns. From 2003, the data has been plotted, whereas Sensex from 2001. So out of 21 years, only for 5 years, the negative return. Similarly, small cap also the same thing. In these 3 slides, one interesting data was, this is the one, 2018 and 2019. Sensex, in both the years, Sensex was positive, almost 20% return it has given. Whereas if you see the mid cap index, in both the years it is negative. 16.5% down mid cap index to 2018 and 2 calendars year. Small cap index, if you see, it is down by more than 31%. So in 2018, the headline Sensex and Nifty was up by 20%, whereas mid and small cap were down by more than 17%, and small cap by 30% it is down. So somebody who has invested in mid and small cap during that time, what happened was that the Nifty and Sensex both were up, whereas the individual portfolio, if you see, it is down by 20 to 35%, it is down. So many of them found it difficult to digest it, because generally in TV and all, what they say is about Sensex and Nifty only they will say. Daily they will tell that market is going up, whereas our portfolio daily, if you see, it has been coming down. So many of them got suffered into that. So in order to get big return in the market, it will test patience. So somebody who sold mid and small cap stocks during that period because it was underperforming, Sensex was doing well, and they shifted money from small cap and mid cap stocks to Sensex mix. In the next 5 years, what happened was that mid and small caps did exceptionally well, whereas Sensex and Nifty did not give the return like this one, mid and small cap index. So many times it used to happen. For interim period, portfolio will do very badly, but whereas the other stocks will do well. What we will do, we will sell our stocks at the lowest point and we will buy the stocks which has been performing at the highest point. And coming next to 2 years, 3 years, the reverse will happen. Again, we will be the loser during the next 2 years, 3 years. So far.
You mean that when we invest in small cap now, right now, there is a possibility that it will go up?
No, now if the reverse is there, Nifty and mid and small cap done very well, whereas Nifty has not done very well in the last 2 years. It has given only average returns. So what we have to do is that we should know well about the company and we have to hold with patience. That's what I am telling. Just we should not buy because the one stock is going up. We should not sell it because the stock is coming down. That's what I am telling. This is the period where I too found it very difficult because we are managing portfolio management services and we had many mid and small cap stocks. Our portfolio also underperformed. We got lot of complaint from clients. They are telling that index is going up whereas your stock portfolio is coming down. And some of the stocks we had it at that time. Now when I compare it now, it is up by 15 times, 20 times. Many stocks which we had it in our PMS, many mid and small cap stocks, whereas at that time it underperformed and we switched to some of the large caps and that stock went up by 20-30%, whereas some of the stocks we sold went up by 10 times, 15 times. It happened not only to us, many of the fund managers it happened.
In future, large cap will perform.
Large cap will perform, but mid and small cap also there is enough opportunities there.
What is the conviction for 2025?
It's a stock picking market, sir. 2025 will be a stock picking market. Yeah, large, mid and small. I feel in all the three segments enough stocks will be available to buy. And this is some of the large cap companies which fell from the peak in that journey. See, many clients used to come and meet me daily, and they will bring their portfolio, and I used to see many of their holdings. And some of them will be holding ITC, holding for 3 crores, 4 crores, and they bought it many years back. In the 1980s, 90s, they bought it. L&T, they will be holding 1 crore, 2 crore worth of shares. HDFC Bank, many people are holding it. 2 crores, 3 crores worth of shares. They bought it in 1990s. Similarly, Asian Paints like that. But how it became, they invested only few thousand rupees as an initial investment. That has grown into this much of money, 1 crore, 2 crore, 3 crores like that. But during that interim period, many times they have tested patience. The stock would have fell by 50%, 60%. Again it has bounced back. Divi's Lab, one client is holding more than 2 crores worth of shares. But Divi's Lab in the last 10 years, 15 years, if you see, means many times it has fell by more than 50%. But again it has come up. And this is some of the maximum drawdown in the last 30 years. If you see that some of the blue chip stocks which are now at a huge value. From the peak, HDFC Bank down by 55%, Reliance from the peak it has down by 68% during Jan 2008 to October 2008, ICICI Bank by 82%, Infosys by 83%. From the peak it has fell from March 2000 to October 2001, L&T 77. All big companies, local companies were down more than 50% in their multi-bagger journey. And globally also, if you see, many companies were down by more than 50%. Microsoft down by 75% from 1999 to 2009. Apple 82% it has come down. Nvidia, which is the star of 2024, it down by 90% drawdown they have seen from January 2002 to October 2002. Amazon during the dot-com bubble time fell by 94%. Alphabet, which is the Google, into the November 2007 to November down by 65%. Meta, recently it fell down, which is the Facebook at that time the name was. September 2021 to November 2022, it is down by 77%. Eli Lilly is the pharmaceutical company by 75%. So the The simple point is, if you want to make big money means some pain we have to undergo. It's not easy to make money. HDFC fund, FlexiCap fund, almost completed 30 years now, and the CAGR it given was a phenomenal CAGR it has given in the last 30 years. So during this 30-year journey, many stocks they bought it has come down, NAV was down, but still over a 30 years period they managed it. Some period of time NAV would have fell very sharply in 2007 and in COVID time, but still over a period of time they managed to create big wealth for the mutual fund investors. So long period we have to see it. Short term, anytime we will see correction, 10%, 20%, 30% correction we used to see it, and it's a normal. Generally one plus about the market correction is that we could able to get the stock price at the lower rate. See, now for the last 2 weeks markets are correcting, and some of the long term investors have become active. They are posting in the social media that they are closely watching the market to enter it, because in the last 1 year they could not able to buy any stocks because of high valuation. Now markets are correcting, and they are becoming active. Moreover, now result seasons are coming, so during the result time management commentary will be there and outlook is positive means they will buy it.
This 83%, 82% down for Infosys and ICICI
Yeah.
is excluding any split or bonus.
No, all included, sir. Included, yeah. Infosys fell. I know that during dot-com bubble time it fell by 83%. It fell from the peak. It's not only Infosys. At that time during dot-com bubble, many mid-cap stocks were there, like DSQ Software, Silverline, Pentamedia Graphics. Everything has become zero. Only Infosys, Wipro, very few large caps survived the dot-com bubble. TCS listed only post dot-com bubble, 2004 only listed. DSQ Software has vanished. Infosys was there, Wipro was there. Wipro also would have fell very sharply at that time. Satyam Computer, it got merged. Satyam also one of the star in the dot-com bubble period. So stock market is usually will be an volatile. So somebody who don't want volatility means best thing is to go with the multi-asset allocation. So I don't want to face volatility. I want to be safe means the best thing, if you cannot stomach the volatility means the best thing to go is the multi-asset allocation, because the multi-asset allocation has worked well across countries over long period. And this is the Indian market. So equity returns around 13% is it given 20-year CAGR, 13% it has given, and debt instruments 7.4, international equity returns around 9%, and gold returns. You see, one beautiful thing about in the last 20 years in India, equity and gold has given equal returns, 13%, around 13% both has given. So one positive about gold is that rupee every time rupee gets devalued. Rupee always get devalued over a long period of time. Every year around 3 to 4% rupee get devalued against the dollar. So gold is a natural hedge against the devaluation, and gold has given almost equal return with equity. In many other countries, if you see, gold has given higher return than the equity. And so overall the multi-asset return in our country is 12.4. So the thing we have to see is this standard deviation. Standard deviation is nothing but the volatility. So the equities standard deviation is 21%, whereas the multi-asset, which consists of equity, debt, international equities, gold returns, and that standard deviation is just 11.3. So the volatility will be less for multi-asset allocation. And some of the countries, across the countries it is the case, the standard deviation when compared to domestic equities, when compared to multi-asset, the volatility will be much less in multi-asset. And in some of the countries, if you see that gold returns are much higher than equity return. In Thailand, if you see, equity has given 3.8, whereas gold has given 8.6. China, equity has given 7.1, gold has given 8.7. Japan, if you see, equity has given 4.5, gold has given 11.7. And US, almost the same, equity 8.2, gold 9.3. And UK, equity 2.7, whereas gold 11.7. So that is why many are advising to go multi-asset allocation. But in India, the already households, most of them used to buy gold, and we have a natural hedge against it. No need to separately invest in gold. That is the advantage we have it. Already our households, we own gold, and that natural multi-asset allocation we have it because of the uh, thing we follow from our ancestors on asset allocation. Every household mostly own gold, and because of that, the overall multi-asset returns will be higher if you include gold also into our portfolio. And this is the FPI flow, and FPI flow in 2024 is almost flat. Nil in foreign institutional flow is there. When you compare the primary market, this data is taken from SEBI data, NSDL data. NSDL, this data has been taken, almost flat it is. But if you see that many of them by 2024, they would have told that FIs have sold 3 lakh crore worth of shares in equity, but that comes from this cash market action. This data is given by the stock exchanges daily. From January to December, it has been plotted. October, we had a highest selling of 1,14,000 crores. FIA sold it. In November, 45,000 crore. In December, 17,000 crore. So it has come down month on month from October, and that is 3 lakh crore. So the one disadvantage about seeing this data is that it is only the cash market selling in stock exchanges. This data is put in by both NSE and BSE. One disadvantage about is that for example, I will tell one thing. In Hyundai IPO, 27,000 crores IPO, FIs bought 10,000 crores worth of shares in Hyundai IPO. But in buy, it won't reflect in anywhere except in this NSDL portal. In this figure, it won't reflect. 10,000 crores they bought in Hyundai IPO. When the stock got listed, suppose if they sell 1,000 crores of Hyundai shares, means immediately it will come in the sell, it will come. So buy, it won't get reflected, whereas in sell it will get reflected. Similarly, many companies are coming with QIP issues they are coming with. So many FIs participate in that QIP issue. In buy, it won't get reflected in this stock exchange data. Whereas if they sell the shares which they bought in QIP, means then it will come into the sell figure. That is why the total figure is very high in stock exchange sell figure, because it don't take into account of buy figure from FIIs. So actually it will be much less. So we should not get a panic that FIIs have sold 3 lakh crores, because buy was not reflected. The primary market buy and QIP buy was not reflected in this. So,
Primary market investment can we get from any place?
yeah, we can get it from NSDL. We will get it. So this the previous slide I showed it now, sir. So it is a combined primary market and a secondary market. And if you take that, it is almost nil. Whereas if you see only secondary market, it is a sell figure of 3 lakh crore.
Now, if you consider the total sold items, like the 1.5% on what they hold, suppose they sell another 1%, what is the condition?
Oh, domestic funds are getting money, no sir. Market may fall by another 5%. That's all. And 2024 FIs are not coming. There are many reasons for that. One thing is that US market is doing very well. So why should they come and invest in India? Because their own mother market is doing very well, and in that they have got 29%, 23% in dollar returns. They have got it. The benchmark index, they have got it. So why should they come and put money in India, where India has given just a 6% return in dollar terms? In that you have to pay the long-term capital gain and short-term capital gain tax. So why should you come and put money in India? So that is one reason why FIs are not very happy to put money in India. And second thing is that many market has given very good return apart from India in dollar terms. You see, German has given 12% return, and Straits Times Singapore 13, and Hang Seng 18, Taiwan 20. It has given more than the double-digit return. Even though the Nifty is up by 8.8%, for FIs it is 5.9, because there is a rupee depreciation factor is there, and if you factor that, just 5.9% return is they have got it. 10-year US bond is now at 4.7, just 1% higher return they have got when compared to the bond. For that, why should they take the risk and come and put in India? So that is why they are not coming in India unless we grow very strongly. There is a huge action by the government on policy front. They are not much enthusiastic. When either US market return has to come down or globally other market return has to come down for big money to come into India. And this is the rupee weakness, and rupee has weakened, and now yesterday actually it touched the 86, it has touched. Gradually rupee is weakening. Since my college days I am watching, the only one way rupee used to go up is to depreciate against the dollar. Except between 2005 and 7, only 2 or 3 year period, during all other periods rupee tends to depreciate against the dollar. We don't know exactly why it is happening. We have trade deficit, whereas many NRIs are sending back to us money, but still rupee used to depreciate. At that time the current account deficit was very high, but still now it is very manageable only, but still rupee depreciate. The pace of depreciation has been very sharp now. In the last 1.5 months, the pace of depreciation has been very sharp.
Because of inflation within India compared to US.
Yeah, but still every year rupee depreciates by 3 to 4% on an average. If you see any decade, if you see from 1990 to 2000, 2000 to 2010, 2010 to 20, except a few years 2006 and 7, like that, all other years we have depreciated by 3 to 4%. So that is why all these IT companies are surviving. Suppose rupee is as in depreciated, if rupee is still at 40 rupees, 50 rupees means, then IT sector would now have been there, which we are seeing now, which is an employee generator of our country.
In 1983, $1 was 11 rupees.
Yeah. And
Produce the importers also.
see, but this story we are hearing for the last many decades, sir. If rupee weakens, import will be costly. Export, it will boost exports. But how many years this is happening? Last so many decades it is happening. Still we are not a big exporting country. Still we import many items. Still trade deficit is there. But this time what they are telling is that why rupee is depreciating, what they are telling is that actually rupee depreciation is much less when compared to other currencies. Actually it is the dollar strengthening which has made the rupee weakening. That is the argument made by many economists now. They are telling that globally many currencies has depreciated much more than the rupee. Rupee has depreciated much less, whereas the many other currencies, even Taiwan currency and many other currencies, they have depreciated by 8%, 10%, 7% like that, whereas rupee has depreciated much less. That is what they are telling, and this is explained by this dollar index. See, dollar index has been sharply up from October onwards. So whenever this dollar index goes up means, which indicates that dollar is strengthening against the 6 major currencies, which includes euro, yen, Swiss franc, Canadian currency. 6 currencies they used to benchmark in this dollar index, and if dollar index going up means dollar is gaining strength. So from October onwards, if you see, dollar has gained a huge strength, and because of that globally many currencies are weakening against dollar, and they are including India also now. In India has relatively done better than many other currencies. That is the explanation given by our government and many economists.
Sir, will there be any change when Trump takes power?
We have to see it. We have to see what he does. He is going to put some tariff on many items, which means the price will go up in US, and which will be inflationary in US for time being. But in the last time when he was in power, he lot of things he told, but only few he implemented. Many times his speech will be like a noise only, but nothing will happen on the ground. See, just another 10 more days is there for him to take the power. 2 days back, Biden government made some restrictions on Russian oil movement, and crude oil prices went up by few dollars yesterday. $2-3 it went up by yesterday. So just 10 more days are there. Still Biden, current US president, is taking some measures. Suppose after 10 days if he comes and if he reverse means, what is the use on it? Generally in our case and all, no government will take big big action when they are going to lose their power in the next 10 days. But Biden keeps on doing many things now.
Australian currencies, the six currencies.
I don't know Australian currency. I have to check it, but weightage will be less. Main weightage is a euro and a yen. Almost 70% of weightage in dollar index is euro and yen. And GDP growth now for current year they are estimating 6.4. Initially they were estimating around 7% growth, then 6.8. Now this is the advanced estimate. Because budget is coming, so just before budget this advance estimate will be done. Based on this estimate only they will prepare the budget for current year. Now the February 1st the budget is coming now. So when what is the negative of lower GDP growth is that the fiscal deficit and all everything is told in terms of GDP. When GDP growth is less means what will happen? Fiscal deficit will be more. Actual fiscal deficit will be more because of lower GDP. So government expenses they will cut it in order to maintain the same fiscal deficit they mentioned in the last budget. 4.9% they have mentioned. Suppose if the GDP growth is 7% means they would have spent more money government, but now the GDP growth has come down to 6.4 estimates, which means that the government spending has to be reduced in order to meet the last year projection of 4.9% of fiscal deficit. So growth is very much needed for a country like India. Just a 6% growth is not enough because so many youths are there and we have to give employment to them, and even auto sector is not doing well. At least 7% growth should be there. We can tell that 6% is one of the best in the world, but for a country like us where so many youth populations are there, 6% is not enough. It should grow at least to 7% GDP growth should be there.
What are the major expectations in the budget?
Actually there is no expectation, sir. The major expectation is that they should not hike a capital gain tax. As far as stock market is concerned, I am telling. For somebody who is going to office, middle class man, he will tell that income tax slab should be hiked by 2-3 lakhs, he will tell. So it depends upon their vested interest. Those who are in the same, in their category, no, they will tell. In stock market, they don't want any hike in capital gain tax and STT. That is what the expectation. Already done.
Highest in the world.
Yeah,
The highest.
not the highest in the world. Our capital gain is not highest in the world. But in spite of all this negative, the foreign investors cannot ignore India, because if you see that this is the gross fixed capital formation by a country, which is nothing but the spending on infrastructure and port like that. And if you see that in 2024, India is the third. This is yellow color is the India. India is the third largest country in the world, which spends more money on infrastructure, railways, and the economic part they are spending it. Capital formation part they are spending it. Third largest, India is the third largest. In 2000 and all, we are some 7 or 8. So gradually we inched up, and now we are the third. The first two are, the first one is the China, almost 8 times more they are spending it. US almost 5 to 6 times more they are spending it, and we are the third largest. And our growth has been going up by 8%. There's a gross fixed capital formation by a country, CAGR for 34 years is going up by 8%. And if you see country like Japan and all, it was second before 1995. Now if you see, they have come to fourth. So in spite of all this negative what we are talking about, FI selling, stock market falling, foreign investors cannot ignore India, because to find growth means only 2-3 big countries are available. China already population has peaked out, now population started falling. So once the population started falling means there is no use of investing more money. Japan faced the same consequences in 1980s. When population peaked out and started falling means, what is the purpose of building more roads and rails when there is nobody to use it? So China has reached a state, and maybe they may spend little more, but here only we are having a lot of young population, growing population, more less than 20 years old, and for that only infrastructure can be spent. So in spite of all this negative gross fixed capital formation by country wise, if you see, India is in the third place and likely to go up much higher from here. And our household relatively under leveraged also. When you compare to other countries, this is taken from RBI side, and if you see that our households are less leveraged. Whenever we are less leveraged means we can take more leverage and spend money, and that will indirectly boost economy. When compared to emerging markets, we are much less. So that advantage also we have. The other thing is that we have lot of gold as a saving, historical savings is there. That advantage also we have, where no other country in the world has that benefit. Mutual fund flows, it's very steady. Around 40,000 crores are coming every month, and a lot of NFOs are coming. But almost now for the past 7 months, the returns are almost zero returns. If you take any mutual fund return, because market has not given any return. Suppose if more than 1 year, if the returns there is no return, it may be negative, marginally negative. Suppose if it is more than 1 year, if it is negative means, then some of them may start thinking about it, because most of the money coming from SIP only, and if returns 1 year nil return, whereas if I have put the same money in the bank deposit, I would have got 7.58% means for senior citizen. So naturally I am losing the opportunity cost. Then people may start thinking about it. Right now it is doing well. So sir told if I sell another 1%, what will happen means, this domestic they will continue to buy it. Maybe market may fall by another 5%, market may fall. That's all. Now right now the mutual fund inflows are very steady, and no one has got panicked, and SIP contribution 26,000 crores highest ever is there. Even though many are closing, many new accounts are getting opened. That's why the gross collection is 26,000, and if you see the net equity inflows among all categories, it is more than 40,000. And events to watch, Q3 results we have to see. It is started coming. Trump action, US President Trump, what he is going to do, that we have to see. And union budget on February 1st, that will be very, very crucial for markets to get back the momentum. Till then market is going to be very volatile, may fall also. But February 1st, if there is no hike in capital gain tax, some tweaks, some concessions are given for middle class family means, then market will take it as an positive. And for infrastructure spending, some announcement comes means, market will take it as a positive. So it will be very crucial. And this time the budget is coming on February 1st, which is Saturday. So NSE and BSE will remain open for trading on Saturday, and February 1st, which is on the budget day, on account of union budget. So it's a hectic day on February 1st. Actually, one of my relative has marriage on 2nd. Initially I thought of going on Friday night, but because of budget, Saturday night only I have to go to my native place. One day got postponed because of the market and union budget. So finally, one thing is, don't get scared of the market correction, sir. See, what used to happen is that many times we can sell it. Some of the good companies, many times what happened is that on fear of market correction we sell it, then the stock will fall, but suddenly it will go up. We could not be able to buy that stock, and the stock will go up from there. So never scare of market correction. Always see market correction as an opportunity. You take it, good opportunity will come. If you closely see means, for the last 2 months we haven't given any conviction ideas. Only New Year peak and Diwali peak we gave, and then the second Saturday recommendations we are giving. Conviction idea recently we haven't given, because I could not able to get a convincing stock idea. Now the market has corrected and results are coming, and most probably we will again start, I will start getting some good opportunities in this fall, and then we will again give the conviction ideas, and you can follow and buy that, but never get scared of correction, and take it as a part of the long term investment. Thank you.